Hello and welcome to Oil Market Insight. We're here today at the OPEC headquarters on the occasion of the 177th meeting of the OPEC conference. And joining me on our panel of experts, Halima Croft. Halima is the Managing Director and Global Head of Commodity Strategy for RBC Capital Markets. Halima, thank you so much for being with us. We're also joined by Alicia Lukash. Alicia, the Senior US Shale Analyst with Rystad Energy. Great to have you aboard. And Jason Schenker. Jason, of course, is the President of Prestige Economics. Now, Jason, let me just start with you, if I can, and really have a look at perhaps what's going to be impacting, what is always impacting the market. But number one, the state of the global economy. I think let's get an overview in terms of how things are looking out there, what we need to be concerned about, what we need to be watching, and bring us up to date.
Well, I think the first thing is that we saw a really big slowing of growth in 2019. Looking into 2020, global growth is likely to remain choppy. We're going into the year as the Eurozone's in a manufacturing recession. The U.S. is coming off of a business investment recession, and Chinese manufacturing is only modestly growing. These things are going to be challenges for the year ahead. That's important to watch. Against that, though, is the reaccommodation of monetary policy. So the Fed and other central banks have taken steps to cut rates or expand, or in the Fed's case, re-expand their balance sheets. And these sorts of moves are going to be positive for growth in the year ahead. They're also likely to be supportive of asset valuations and the price of things like crude oil.
And of course, these are all elements that have to be watched day by day, week by week, month by month. Halima, let's look at what's going on in the OPEC countries particularly. And given the state of the global economy, how are they faring? Give us a sort of a quick run round on some of the key producers and how things are looking.
I mean, this has been a very challenging year for the OPEC producers. It looked like the market was actually tightening significantly after the Trump administration had really tightened sanctions on the import of Iranian oil. And then we had the resumption of the trade war, causing prices to crater again. So we see basically a tale, in some respects, of two OPECs. Some countries had been very successful for the past couple years of adapting to the changing energy landscape by making investments in new capabilities like trading capabilities, working with international oil companies to develop complex acreage, a country like the United Arab Emirates, and other countries have really suffered from an inability to attract investment. Now we're seeing some of them, like countries like Algeria, responding by trying to bring in things like a new hydrocarbon law. We see the Angolans trying to reverse the decline in investment by coming up with new incentives to attract foreign investment. And so again, I think it's a challenging environment. Some were earlier to think about adaptation than others.
Now, of course, in the mix of all this, and Alicia, you can help us here, given your expertise, particularly in shale oil, we have to look at what's happening in America. And we're seeing record production. It almost goes every year we're going to see more, and probably more to come. Bring us up to date in terms of how things are looking at the moment, particularly on the production and the supply side from the U.S.
So we just received the latest numbers from the EIA stating that we already had a week of 12.9 million barrels per day on the supply from the U.S., which is quite surprising to some because the rig count was dropping significantly across the U.S., as well as the fracking rate has stayed very low for the fourth quarter. But U.S. is still pretty strong, and for this year, 2019 specifically, it's partially because a lot of the front-loaded capital actually resulted in the back-loaded production volume. So we're now seeing all of those volumes finally hitting the market, and essentially 2019 should end around 12.9, 12.8 million barrels per day, giving us a stronger start for 2020, despite the lower financing that we've seen so far.
And I want to talk to you about that in just a few minutes. We'll stay with it. Hold that thought. Talk to me about when we look at growth in demand, Jason, and particularly when we look at U.S., looking at the economy there, despite some of the worries perhaps earlier in the year, people talking about throwing out the R word. It didn't quite happen. But talk to us about the state of the U.S. economy right now. And of course, we're looking ahead to a year where we're going to see elections. And how are things playing out? How comfortable do you feel sitting in Texas right now?
Yeah, so there's two things. I mean, when we think about recession, most people, because of saliency bias, they tend to think of the Great Recession. And what they don't realize is that we had a manufacturing recession. There was a business investment recession in the United States in late 2015 and early 2016. And yet the whole economy remained buoyant. Why? Because 70% of the economy is driven by consumption. And right now, the labor market's even stronger than it was in 2015, 2016. We did have and have had a, right now, ongoing business investment and manufacturing recession in the U.S. again. Does that threaten the overall economy? Not as much, because 70% is driven by consumption. Job market is great, lowest unemployment rate in 50 years. Wages are up. Those things are positive for the overall economy, still remaining positive, even though we see GDP growth slowing. Where this year we were expecting 2 to 2.5, we've been consistently expecting next year would be 1 to 1.5. We still see that kind of range. Front half of the year could be weaker, back half could be stronger because the monetary policy takes a while to kick in. Against that backdrop, though, on a global basis, the other place to look is China, because that's one of the biggest sources of additional marginal demand for crude oil. China is the biggest net importer in the world of crude oil right now. All the OPEC forecasts really underscore how important China is for demand, and the U.S.-China trade war could continue on. It has, as we've seen, even recent legislation has been passed in the U.S. supporting Hong Kong against China. This shows that some of the challenges in the relationship between the U.S. and China might not be very quick to thaw. And what that means is that we could see this kind of conflict maybe continue on. If that happens, it'll be a challenge for Chinese growth. But as we've already heard, some of the manufacturing and supply chains will maybe go and spread around, disperse to other economies. But global demand growth still likely to be 3% or so in the year ahead. It's just maybe where the additional demand comes from, and the additional oil demand might not be as China-centric as we've been previously forecasting.
And again, when we look at the year, we see the Chinese trade talks, I think, is almost like 5 steps forward, 3 back. Everybody wants to see some resolution. It's not happening as quick. Halima, when you look at what's going on there, the importance of getting this deal done, and I suppose the uncertainty that it's causing and has caused for the year in the markets around the world. I mean, how damaging is not knowing what's going to happen?
Well, I think not knowing what to happen and the uncertainty makes it particularly difficult for finance ministers, for energy ministers. If we think about OPEC decision making, it's hard to have that crystal ball when we basically have very conflicting signals about where these talks are going. But to pick up on a point that Jason made, I think it's really important to think about the sort of U.S.-China relationship, because there could still be trouble spots in the U.S.-China relationship even if President Trump is not reelected. I mean, there are issues that are in this relationship from a security standpoint. There's Hong Kong. There are issues over South China Seas that could further complicate efforts to off-ramp the tensions that we've seen building. So again, I think this is something we could be dealing with in terms of U.S.-China relations, regardless of who is in the White House.
Let's have a look, Alicia, particularly when we look at financing. And again, depending on what's happening in America, investment is good investment will, good projects will find good investment. And, the oil companies are still looking for investment without a doubt. It's shifting a bit in terms of the levels of investment and the sources of investment. Where is the investment coming from, and where are the big companies looking for it?
Right. So first of all, to mention that the reason why historically we've seen so much inflow of capital into the industry is mainly because, in theory, shale rock has 2 years return time. While you look at the offshore and the other supply sources, it's between 5 and 7. So obviously at the beginning, and especially with the shale boom, so much capital started flowing in, and it's not just US, it's obviously Europe as well as the Asia. However, lately, because there's been a huge pull, basically a pullback of the capital, the operators themselves started kind of self-financing their operation. And it's actually the second quarter in history that we've seen the benchmark of the public shale producers actually balancing out in terms of how much they spent and how much they generated of the operating cash flow. So just for the years to come, I don't think there's any particular expectation of all of a sudden shale becoming highly attractive again from the investment point of view. However, the economics is there. So we're still looking at wellhead break-even prices can drop below $30 WTI compared to, obviously some of the other areas in the U.S. can be above 50. So it's very diverse. We shouldn't forget that U.S. is actually hundreds of operators, including private, public, as well as the majors. And the financing is probably the strongest is actually from the majors, because they have financing projects for multiple years, while public operators are highly kind of volatile to whatever is happening out there in the market. And it's just, we spoke about US-China trade war. The equity market of these public producers actually reacts the most. It actually reacts more to the political situation rather than to actual WTI prices. So it's definitely a shift in the industry that happened this year. And just for the 2020, we expect private operators and public and kind of public majors to lead the most of the growth from the U.S. rather than just public independent producers.
Now, Halima, when we look at the stability that's needed in the market, I mean, OPEC has constantly spoken about this. And again, here we are almost 3 years into the Declaration of Cooperation, or as you like to call it, the Vienna Alliance. Talk to me about how important you see that alliance, the Declaration of Cooperation, and then following on to that, the Charter. Has it, and when you're talking to your customers and you're talking to your clients, has it brought that stability into the market, and what are they saying about it?
I think OPEC establishes a very important floor in the market. And I think when the Declaration of Cooperation was announced 3 years ago, we're 3 years into this union, I think there's a lot of skepticism about whether you could have some of these key non-OPEC players like Russia work alongside OPEC. And so I think what they've been able to do is they've been able to show that they can even bring more countries into this partnership. And so it looks like something, I think now from an investor standpoint, that we're not doubting the willingness of these countries to work together. The issues that remain and the challenges that remain is ensuring better compliance. And that is something that we've heard a lot about recently. His Royal Highness Prince Abdulaziz bin Salman has been very vocal about wanting better compliance, that everyone is going to work together and carry their own weight. So I think that is a sort of next step for OPEC. As we think about the union holding, it's just how do we ensure that all countries are doing their part.
And indeed, it is about everybody doing their part. And we look at OPEC and the wider, cooperation that's coming. And Jason, when you look at, OPEC and OPEC Plus, and it viewed too, I suppose, from international eyes, do you think OPEC is doing as much as it can do at the moment? Has it done everything it needs to do out there to make sure that there's stability in the market? Oh,
yeah, I think so, especially if we consider the fact that we've had a Chinese manufacturing recession, a Eurozone manufacturing, and a U.S. manufacturing recession the last year, and oil prices still are where they are. Because the same thing happened. China went into a manufacturing recession at the end of 2014 that lasted until the middle of 2016. And we all remember what happened to oil prices during that time period where they really hit that bottom in the early part of 2016. We haven't seen that in oil prices this time around because the group has had much tighter control over the production despite a big shale boom. So I think that shows it's been effective. We didn't see a massive collapse. Look at what happened to aluminum prices in the last 2 years, or copper, or a number of other industrial metals. Those markets, just the bottom completely fell out. They have absolutely tanked. And yet we didn't see that happen with oil, and that's because OPEC's got its hand firmly on the rudder.
And again, I think we look at this around the world and we look at it in terms of efficiencies that everybody brought in. At least I want to bring you in here too, looking at the efficiencies of all the industries. I think years ago also we looked at shale, we looked at American production. It probably had a bit more money around many years ago. But I think everybody has actually kind of tightened their belts and looked at efficiency. Well, how good has this been for the shale operators?
Well, it's been, especially 2019 has been a very controversial year in this sense. So the strongest efficiency has actually been achieved in 2017, just after the collapse of the prices. And since then, obviously the OPEC being able to maintain the prices in a particular range allowed U.S. operators to further reduce their break-evens, but now not because of the cyclicality of the market, but rather structurally change their cost per barrel. So essentially, the break-even prices shifted further $5–10 from the levels of 2017. But now this shift is actually stable for the years to come. So definitely, a lot of this has actually been driven by, subsurface kind of developments in terms of the spacing, the intensity of completions, the well design in terms of lateral lengths. But right now, the industry actually doesn't require that much capital to grow the production, which is kind of different. It makes it more challenging to forecast the U.S. production in one way, because it's the hardest is to understand the economics, the hardest to forecast the change of this economics per barrel. But on the other side, because we know that the external capital markets are at the lowest right now, it's easier to forecast how much capital is actually going to be spent on drilling itself. So just an interesting comparison that this year it was the first time that actually public producers that never paid dividends, never bought back the stock, as such, they actually already spent $7 billion on just maintaining equity prices instead of putting it into the drilling. So for the coming years, definitely economics and the shift in the market made producers kind of more, it made it easier to produce the barrels, but every year has its own challenges. So into 2020, we expect the levels of financing being probably 10% lower than 2019.
And one of the other bigger challenges, Halima, if you would address also, I think, and we've seen this at many conferences throughout the year, I'm seeing the environment and climate change really being up there at the top of everybody's agenda. And I think we're beginning to hear it more from the oil and gas companies. How important is it that everybody takes this very seriously and actually starts delivering on the promises that are in place?
Oh, I think it's incredibly important. I mean, we've seen major protests outside of key conferences. I think the ESG agenda is becoming incredibly important in the boardrooms of these companies. They understand that they will be punished by shareholders, endowments, particularly, university endowments. There's a lot of pressure to be responsible in honoring these commitments. So I think that message is actually loud and clear. And I think this is something that the industry is also going to have to adapt to very rapidly.
How are you finding that, Elisa, impacting the investment then in the American companies? Is it something everyone's keeping an eye on?
Yeah, definitely. I would say investors have probably the strongest push on the industry as such. And obviously, the more environmental concerns we're seeing, coming from pretty much every country, European investors actually pull back the most. Americans now changing as well. But I guess the strongest push is actually expected to come from operators themselves. So we talked about flaring rates and what we've seen happening in different states. The problem with the US, it's not really standardized across the whole country. It's different and it's evolving, year by year. But we've seen already some of the operators like Pioneer, for example, pushing for further reduction in flaring in Texas, specifically in Permian. And we expect that to roll over into 2020, not just in Permian, but actually across the US.
Now, Jason, we have to look also at the environmental concerns, but I think also, the fact that oil and gas is still needed and investment is very much needed. So it's sort of a tough parallel path in many ways that people have to navigate.
Yeah, you've got these two huge bifurcated dynamics. On the one hand, you've got the fact that 30 years from now, the global population will include 2.1 billion more people than it has now, and that 30 years from now, real per capita GDP in China and India will be triple the level it is now. The fact that you see people's wealth rising and population growing makes it very difficult to actually expect to see significant CO2 abatement or reductions in the future. But that doesn't mean, to Halima's point, that we're not going to see this. We are going to see it. We saw almost 40% of activist investor initiatives in 2018 were tied to climate change, sustainability, or something else environmental. And we're going to see that. We've seen record all-time highs of overall activist investor activities and initiatives in 2018, both in the U.S. and globally. We're going to see new records of that going forward. We're going to see probably even a rising percentage focused on environmental and sustainability and climate change sort of issues. But it's very difficult for companies to imagine in this boardroom, I'm going to affect climate change. They can think about how they're going to be more energy efficient, or they might reduce their footprint of CO2 or the like, but to actually impact climate change at the board level, that's a very difficult thing to actually do, especially as we see a rising global population with rising wealth. So these are really big challenges because energy is a fundamental ingredient of economic growth and wealth, and the economy does not grow without it.
And I think this is something that, I think the industry probably is a message it needs to maybe spread probably clear in 2020. Looking ahead to 2020, and please follow on from what Jason has said in this, but I'd also like your sort of closing comments on that and a look ahead to 2020. What can we expect? What should the OPEC producers be looking at? OPEC, non-OPEC, OPEC plus, as we close off this year now, what do we need to be looking ahead to?
Well, I think OPEC and OPEC Plus will focus on things that are under their control. Their ability to maintain discipline on their cuts, on their messaging. Because we have to expect volatility coming out of Washington in terms of trade policy, in terms of sanctions policy. So their ability to be responsive quickly to change in environment. I think that is one of the beauties of the JMMC structure, is if there is a significant change in the external environment, they do have the ability to convene and switch course on production policy.
So, but would you say then that it's also about looking at this almost day to day, week to week, month to month, as well as keeping an eye on the long term?
It's the ability to be nimble over the course of the next 12 months, but also continue to have a long-term horizon when you think about broader policy initiatives.
Elisa, again, looking ahead to 2020, looking at the US market, are we going to see more consolidation on shale? I mean, are we going to see more production? What do we need, and what does OPEC and OPEC Plus need to be watching coming out of the US?
Right, so I'm probably going to say that, first of all, we have to actually watch a bit more detailed picture rather than just, US kind of activity indicators, because they're very often misleading. And especially this year, we've seen things like, rig count and the whole fracking activity would be so lagging behind the actual, what we can expect into the in volumes. So I guess obviously keeping an eye on what's happening in terms of consolidation of the acreage, because that drives better economics, lower G&A expenses, and basically less capital for more volumes. But of course, just not to forget that U.S. shale is very fragmented and very diversified kind of a landscape. So we have to actually keep an eye on different groups, segments of operators, and forecast them separately. So in 2020, some of the leading operators have been already implementing renewables, for example, in the unconventional drilling, using wind or solar to not just shift kind of a bit away from whatever environmental impact was happening, but also to actually get better economics. So definitely keeping an eye on that. And as of right now, it's really hard to forecast or tell you exactly what's going to be, a dollar change to your break-even price. And it's definitely something that we have to keep an eye in the first and the second quarter of 2020. And just not to probably underestimate U.S. production, because I feel that's what the market has been doing every year. And maybe believe that there is a chance that we might get surprised again and have that flexibility, Just keep an eye on everything.
Indeed. Jason, I'm leaving you the closing word here as we round off oil market insights at the end of 2019. What do we need to be looking at for the year ahead?
So for 2020, I'd like everyone to kind of think about the headline and the trend line. And the headline is going to be focused very much on the central bank policy that's going to be accommodative, and the economic data that indicates whether manufacturing is doing well or not, like the global purchasing manager indices out of the US or Europe, or the Caixin manufacturing PMI out of China. Focusing on those headlines is going to be really important, as is, to a certain extent, what happens with the trade war and the back and forth. But I'd also almost carry that over to part of the trend line, that the potential conflict between the US and China over economic, military, political hegemony could continue and accelerate in the years beyond. So that's a trend to consider. That's going to add volatility. But I'd also say there's a reason OPEC is in Vienna. Even during the Cold War, when the Soviet Union and the US were at loggerheads, oil still moved around because the global economy still needed it. The other couple of points I'd point out are the demographics, long-term trend, people getting wealthier, more people on planet Earth, they're going to need energy. And even though there are substitutions, liquid hydrocarbons are the most efficient form of energy for transportation purposes, full stop. And the last piece I point to for technology, that we're going to see companies work hard to automate, to do robotic process automation in the back office, anything they can to reduce costs, to bring those drilling costs, lifting costs down, to cut their way to profitability so that oil can still flow. And e-commerce. We see that's rising right now in the US. It's still below 11%. We're going to see that continue to rise in the US and globally significantly in 2020 and the years ahead. And that means more miles driven. And that means more hydrocarbon demand. So those are the big thoughts I'd leave.
Well, so the dynamics are, it's very fluid. And even as Halima says, it's about being very nimble to make sure that you can actually handle all of that. We have to wrap it up here. We could talk for hours on this, but I really want to thank you all for being here with me and for your great insight and sharing that with us. Halima, thank you so much. Elisa, and of course, Jason, thank you so much. And thank you for being with us here. This has been the Oil Market Insight on the occasion of the 177th meeting of the OPEC conference here in Vienna. So stay tuned, of course, to the OPEC website, www.opec.org.